Hey everyone, Griffin here, and today I want to walk you through a comparison of the main Canadian investment accounts, which ones are best in different situations, and the pros and cons of each depending on your goals. Now, for newer Canadian investors, all of the names and acronyms TFSA, RRSP, FHSA, RESP, margin, and even cash accounts can get quite confusing quickly. And the reality is a lot of people still don't fully understand what each of these accounts is used for, what the 2025 and 26 contribution limits look like, or how to plan ahead going into the new year. So in today's video, we're going to break everything down in a clear and simple way. I'll compare each account, explain when it makes sense to use one over another, and then help you figure out which accounts you should prioritize if you're just getting started. So let's jump in, and we'll start with a quick refresher on the differences between registered and unregistered investment accounts, because that's the foundation that makes everything else easier to understand. All right, so what's the actual difference between registered and then unregistered investment accounts? These are terms you've probably heard about if you're starting to look into investing, but the distinction is pretty straightforward. Registered accounts are investment accounts that are recognized and then regulated by the CRA, and they come with special tax advantages. And because of this, they also come with contribution limits yearly and certain rules around how and when tax is applied. This category includes the TFSA, the RRSP, the FHSA, and then the RESP. On the other hand, unregistered accounts like a cash account or a margin account do not come with any type of tax sheltering. Any growth, dividends, or income that is made inside of these accounts is then taxable each year or when you sell investments. So the simple takeaway is registered equals tax advantaged with rules versus unregistered equals fully taxable and no contribution limits. All right, so now that we've covered the differences between registered and unregistered accounts, let's go over the key updates that you need to know heading into 2025. After this, we'll break down each account one by one, and I'll explain which one might be the best fit depending on your situation. So starting with the TFSA, the annual TFSA contribution limit for 2025 is $7,000. And if you've been eligible since the TFSA was introduced back in 2009 and have never contributed, your total available room as of 2025 would be $102,000. Now for 2026, if you're watching this, the annual contribution room is $7,000 again, which would bring your lifetime limit to $109,000. For 2025, the RRSP contribution limit will be $32,490, which is still calculated as 18% of your earned income the year prior and up to that cap. Keep in mind that any pension adjustment from a workplace retirement plan will actually reduce your available RRSP room. The first home savings account has an $8,000 annual contribution limit and then a $40,000 lifetime limit. So you can also carry forward up to $8,000 of unused room after the year that you open the account. And if you end up not using the FHSA to buy your first home down the line, you can actually transfer the full balance tax-free over to your RRSP or RRIF without affecting your RRSP contribution room, which is great. The RRSP home buyers plan limit was increased to $60,000 for withdrawals made after April 16, 2024. And there's also a temporary extension that delays the start of repayment by 3 extra years for first withdrawals made between 2022 and 2025. Okay, so next let's talk about what a tax-free savings account or TFSA actually is and how it works. So TFSAs are one of the most flexible investment accounts in Canada. They allow for tax-free growth as well as tax-free withdrawals. Contributions aren't tax deductible though, but the key benefit is that any of the money that you take out doesn't create taxable income. And the contribution room that you used gets added back on January 1st of the following year. So for 2025, like I said, the annual limit is $7,000. And since the TFSA limit is indexed to inflation, we'll continue to see small adjustments most years. So it's worth checking the updated limit each year. The biggest advantage of the TFSA though is the following. Number one, your money compounds tax-free. 2, withdrawals can be made at any time and for any purpose, unlike say the RRSP. 3, withdrawals do not affect income-tested benefits like the GST credits or certain government support programs. And because of that flexibility, TFSAs can work well for emergency funds, saving for medium-term purchases, or even just building long-term wealth towards retirement, for example. However, there are a couple of things to watch out for. Overcontributions are penalized at 1% per month on the excess amount. US dividends inside a TFSA are subject to withholding tax, and that tax generally cannot be recovered. So keep that in mind. All right, so we better understand the TFSA. How should you actually go about using this account? Well, for long-term investing, I typically use the TFSA for higher growth investments like equities or equity ETFs, since the tax-free compounding is going to be most valuable over time. For shorter term goals, you can hold cash, a high interest savings ETF, or even a GIC to keep risk lower while still earning some interest. And if you want to avoid withholding tax issues, you can just stick to Canadian equities or Canadian listed ETFs. Inside the TFSA, these grow completely tax-free, and then your withdrawals remain tax-free as well. By the way, if you want to learn more about how the TFSA works, different rules and technicalities, as well as mistakes to avoid, check out the videos that I've made and released on this channel. I'll leave some links down in the description for you. Hey, before I get into the next TFSA mistake, I want to quickly highlight one of my favorite tools for investing, especially if you buy US stocks or ETFs inside of your TFSA. And that's today's video sponsor, moomoo. moomoo is a fully regulated global stock brokerage with now over 27 million users worldwide, and it's available here in Canada, of course. Their parent company is even listed on the NASDAQ stock exchange, and they're a CIPF member, so your Canadian accounts are protected. moomoo does not charge any foreign transaction fees between Canadian and US dollars. When you move Canadian dollars into your moomoo account, if you choose to purchase US listed stocks in US dollars, well, you can choose to convert your Canadian dollars to USD instantly with no markup at all. To put that into perspective, most Canadian brokers charge around 1.5% every single time you convert currencies to and from US dollars. So even on a simple, say $500 purchase of a US listed ETF, you're losing about $7.50 US right off the top. And inside a TFSA, where returns are supposed to compound tax-free, well, paying FX every single time that you want to purchase a US stock is one of the easiest mistakes to avoid, and it's why moomoo has become such a strong option for Canadians who want to invest cross-border. And as a Canadian investor, you can open a cash, margin, TFSA, and RRSP account, and then trade everything from Canadian stocks to US stocks, ETFs, and even options if that's your thing. Moomoo's also running a seriously solid welcome bonus right now, where if you deposit 5,000 Canadian dollars into your account, Moomoo will give you a $300 cash bonus, basically a 6% return instantly, plus commission-free trading and a 6% APY promo on your uninvested cash. So if you want to open a Moomoo account and secure your own sign-up bonus, make sure to use the link that I have down below in this video's description and pinned comment. Next, let's talk about the RRSP, or Registered Retirement Savings Plan. This is primarily designed for retirement planning, and it works on a deduction now, tax-deferred growth, tax later model. Your contributions reduce your taxable income today in the year that you make them. However, your investments grow tax sheltered inside the account, and then you'll pay tax when you withdraw the funds later on down the line, ideally at a lower tax rate in retirement. Now keep in mind that you must convert your RRSP to an RRIF or an annuity by December 31st of the year that you turn 71 years old. And minimum withdrawals begin the year after the conversion. Now in terms of 2025 contribution rules, you can contribute 18% of your earned income from the year prior, up to $32,490 minus any pension adjustments from an employer plan. Contributions made in the first 60 days of the year can be applied to your previous year's tax return or carried forward to future years. If, say, you know that you're about to have a great year in a year or two with high income, putting you in a higher tax bracket, it can sometimes make sense to utilize that RRSP tax deduction in those higher income years. Now, the biggest benefit of the RRSP is is the immediate tax deduction, which does make it especially useful if your current marginal tax rate is higher now than what you could expect in retirement. Another notable advantage is that RRSPs are the only registered accounts that avoid U.S. withholding tax on U.S. listed dividend paying stocks or ETFs, as long as your W-8 Ben form is on file with your brokerage. You can also use your RRSP for certain programs, such as the Home Buyers Plan that now allows up to a $60,000 withdrawal to purchase your first home. Now, here are a couple of things to watch out for though. Early withdrawals are going to be fully taxable and have withholding tax at the time of withdrawal. So you're usually going to want to wait until retirement to start taking out of this account once it's converted to an RRIF. Additionally, over contributing beyond your available room is subject to penalties after a $2,000 lifetime buffer. So ultimately, the RRSP is an ideal investment account if you're a high earner and want to reduce your taxable income. If you have employer RRSP matching, that is a great time to utilize the RRSP, where you're essentially getting matched contributions. That is one of the best return on investments that you can make. So this is an account you typically fund for the long term, not one that you would use for any type of emergencies or short-term spending. It works best when treated as a retirement-focused plan. Next, let's talk about the FHSA, short for First Home Savings Account. This account combines the two major benefits of the RRSP and the TFSA. One, you get an RRSP style tax deduction when you contribute to the account, and if you use the money to buy your first home, the withdrawal is also tax-free, like a TFSA. So it's essentially designed as the most tax-efficient way to save for your first home purchase. There are some contribution rules to keep in mind though. You can contribute $8,000 per year up to a lifetime maximum of $40,000. You can also carry forward up to $8,000 of unused contribution room each year, but that carry forward only starts after you open your first FHSA. If you haven't opened one yet, you aren't accumulating room. There's also a time limit. The FHSA must be closed by the end of the year where you turn 71, 15 years after opening, or the year following your first qualifying home purchase, whichever comes first. The idea here is simply that this account is meant for saving towards your first home, not for indefinite long-term investing. Here are the pros of the FHSA. One, you get a tax deduction on contributions. Two, if used for a first home purchase, your withdrawals are tax-free as well, being a double tax sheltered account. And if you don't buy a home, you can transfer the entire balance to your RRSP or RRIF tax-free. And this does not use up existing RRSP room. That being said, here are some considerations to make. US dividend withholding tax generally applies in an FHSA, so it's usually better to avoid any type of US dividend-focused investments in this account. Overcontribution also leads to penalties like any registered investment account, and you don't build contribution room unless the account is actually open. So make sure to open it if you qualify and plan on buying a house. All right, so when does this account make sense to utilize? Well, of course, if you're planning to buy a first home within the next 15 years, the FHSA is going to be a very strong account to use. And you can also pair it with, like we mentioned earlier, the RRSP's Home Buyers Plan to potentially increase your total tax advantage down payment. From here, let's cover the RESP, short for Registered Education Savings Plan. This account is designed specifically for saving towards a child's post-secondary education. Contributions to an RESP are not tax deductible, but the investment growth inside the account is also tax deferred. And when funds are withdrawn for education, the growth and grants are taxed in the student's hands as educational assistance payments, EAPs, which usually results in very little tax owed since students typically have low income, if not none. One of the biggest advantages of the RESP is the government grant support. So the Canada Education Savings Grant, CESG, will contribute 20% on the first $2,500 that you contribute each year, which works out to $500 annually, with a lifetime CESG maximum of $7,200. Low and middle income families may also receive an additional 10 to 20% grant on the first $500 contributed. Additionally, for eligible low-income families, the Canada Learning Bond, CLB, can provide up to $2,000 even if you make no contributions yourself. Now, there is no annual contribution limit, but there is a lifetime contribution limit of $50,000 per beneficiary. An RESP can also remain open for up to 35 years, giving plenty of flexibility for timing. Recent changes also expanded EAP withdrawal limits during the first 13 weeks of enrollment, up to $8,000 for full-time programs and $4,000 per 13-week period for part-time studies. So the advantages of this account include the fact that the grant match provides a strong boost to investment returns. Income is taxed to the student, who usually pays little or no tax upon withdrawal, and there's a long time horizon, up to 35 years, allowing for strategic planning. Considerations for the account though, well, if the student doesn't end up pursuing eligible education, any grants must be repaid, unfortunately. Investment income withdrawn as an AIP, accumulated income payment, is also taxed and subject to a 20% penalty, or 12% in Quebec. However, up to $50,000 of AIPs can be transferred to your RRSP if you have available RRSP contribution room, reducing or eliminating that penalty. Finally, let's talk about unregistered accounts, specifically cash accounts and then margin accounts. So a cash account is really straightforward. You invest only the money that you deposit. A margin account, on the other hand, allows you to actually borrow extra funds to invest, which introduces the possibility of leverage, interest costs, and then margin calls potentially. These accounts usually aren't the first choice for new investors because they don't offer any tax advantages, and registered accounts are generally much simpler and more efficient for early investing, but they're still important to understand. So since these accounts are fully taxable though, the type of income that you earn matters. Interest income and foreign dividends are taxed at your full marginal tax rate. Canadian eligible dividends receive the dividend tax credit, and capital gains are taxed at a 50% inclusion rate for 2025. One advantage in taxable accounts is that you may be able to claim a foreign tax credit on US dividends, which you cannot do in some of the registered accounts. Also, if you hold more than $100,000 in cost basis of foreign property at any point during the year though, you are required to file a T1135 form. Now, in certain situations, margin interest may be tax deductible if the borrowed funds are used to earn investment income. So just remember that in non-registered accounts, there are no contribution limits, meaning unlimited investing room. There's also a bit more flexibility for tax strategies and potentially advanced portfolio construction, but if you're watching this video, chances are you're a new investor. All right, so finally, let's talk about which investment accounts you should prioritize, as well as the order to open each one and what a typical game plan would look like in practice. So first, before anything else, make sure that you have a small emergency fund or cash buffer set aside in a high interest savings account. This really gives you stability and prevents you from needing to withdraw from your investments unexpectedly. After that, if your employer offers RRSP matching, contribute enough to get that full match. This is essentially free money, and it's almost always worth taking advantage of, especially if you expect to be in a lower tax bracket in retirement than you are today. But even regardless of that, you're getting free money from employer matching. Now from there, if you're planning to buy a home within the next 15 years, make sure to max out your FHSA each year. After the FHSA, you can then use your TFSA to save additional money towards your down payment or general long-term investing. As a general starting point, this order works really well for most people. And if you have children, consider also contributing to an RESP to take advantage of the government grants and the tax-efficient withdrawal structure later on. And finally, only after you've made use of your registered account room should you look at opening a taxable unregistered account. If you have any questions about each of the account types mentioned in today's video, leave a comment down below. I will respond to as many as possible. And if you want to open up an investment account for yourself, check out the links I have down below in this video's description to get a great sign up bonus for starting your investment journey with the brokerages that I'm partnered with. And finally, if you want to learn everything you need to know about investing in the stock market, check out my 100% free stock market investing course over on Skillshare. There's a link down below. Over 7 hours of content and over 3 3,000 students. So thanks a lot for watching. And with that said, I will see you in the next one.